Most people who own precious metals are familiar with this guy. He's had a few choice words about gold and gold owners over the years. He's called gold an unproductive asset. He's criticized gold as an asset that just sits there. He said, "It's a lot better to have a goose that keeps laying eggs than a goose that just sits there and eats insurance and storage and a few other things like that." And he's right. Somewhat. Most people purchase gold and silver simply because they are long-term stores of value, or because they are good insurance against financial catastrophe, or because they are wonderful ways to reduce the volatility of a properly diversified investment portfolio. These are all great reasons to give up a little income for the sake of owning gold, and I've discussed all of these features at length. But one thing I haven't discussed much is how to generate an income using gold. I've covered it here and there, but never focused on it because up until recently, gold leasing has been the playground of the super wealthy. It has been out of reach of most people. Today I'm going to discuss how you too can earn some interest on your gold and on your silver, and I'll start with how it works and why it works, and then I'll discuss the company that I personally use to lease out a portion of my metal. I will leave a link in the description section of this video if you'd like to learn more. Let's start out with an illustration of why any business would want to borrow gold. I can't stress enough how important it is for the lessor to fully understand how a borrower will use the funds. If you don't understand how your capital will enable the borrower to make a profit, you should absolutely not lease your metal. The only way that interest can be paid legitimately and the capital later returned is if the borrower can do something productive with the capital. There are other things that you'll need to know, such as how your metal will be protected from the claims of other creditors in the event of a business failure, but let's just focus for now on the business case. I'm going to use jewelry fabrication as an example. Suppose that we have a jewelry manufacturer who generates profit by turning bullion metal into fine jewelry. In this particular case, the jeweler would like to transform 1,000 ounces of gold into jewelry. And let's assume the total process from procurement to the final sale of the jewelry takes about 3 months. Let's assume that at the time that the jeweler decides to start the process, the price of gold is $1,850 per troy ounce. I'm just picking this number for illustrative purposes. As you'll soon see, any number would serve the purpose of illustration just as well. The jeweler in this case believes that he can add 50% to the value of the gold through his fabrication effort. So hypothetically, if the jeweler was able to fabricate and sell the jewelry with no time delay, the revenue would be $2,775,000. Of course, there are other costs involved in making the jewelry. The jeweler is probably paying rent on the building that's used as a workshop. He's going to have to pay utility costs to keep the lights on and the machinery working. He's also going to need to pay all of his workers, from his jewelers to his sales team to his janitorial staff and so forth. And he'll probably also have some lease costs associated with the equipment itself. Let's put some hypothetical numbers in place to show these costs. Again, the assumed costs are not critical for the sake of this illustration, but let's at least assume something to make the business case more realistic. I'm just going to assume that the rent for his facilities is $80,000 over a 3-month time span. The utilities will cost $5,000. The salaries and benefits for his team will be $400,000. The leasing cost of his equipment will be $115,000. All totaled, the production costs are $600,000. So, if this was an all-cash business, and the jeweler could guarantee that his product would sell for 50% more than his raw materials, the before-tax profit would be $325,000. This is a respectable profit for 3 months' worth of work, considering the amount of capital involved. But there's a problem here. The big problem is that the jeweler is going to need to somehow obtain all of the gold that he needs. In addition, he'll need to pay all of the production costs before the finished products are ready for sale. Most entrepreneurs are not going to want to stake that much of their own capital. So how is our jeweler going to obtain the capital that he needs? One solution would be to borrow from a traditional bank. Would this work? Let's do a thought experiment. Suppose there's a bank out there willing to make a private 3-month loan at a rate of 8% per year, or 2% over the 3-month loan period. This would mean that the jeweler's interest cost would be 2% of the $1,850,000 required to buy the bullion, plus 2% of the costs to finance production. We can add this $47,000 interest cost to the business case. Once we do this, the before-tax profit drops to $276,000. Now, this is still a very respectable return from the standpoint of the jeweler. He doesn't have to stake any of his own capital. All he needs to do is to arrange the funding, rent the equipment and building, pay his workers, and manage all of the other administrative tasks. And he'll end up making a pre-tax profit of over $250,000 in this 3-month period. I'd enter into this business if I had the knowledge, wouldn't you? But I haven't yet discussed the critical flaw in this business plan. There's a 3-month delay between the procurement of the gold and the sale of the finished products. In the gold world, a lot can happen in 3 months, such as we've seen the price of spot gold fall by about $200 per troy ounce over the past 3 months. So for a person who is saving in gold, such a price drop can be annoying, but it certainly won't be as damaging as it can be to someone who's running a business whose chief working capital is gold. Let me show you what would happen to our unfortunate jeweler if the price that he could obtain for his final product were to drop by 10%, similar to the price drop that we've seen in gold bullion over the past 3 months. Because of the drop in the spot price of gold, the jeweler will see a reduction in the value of the gold jewelry that he can sell. The raw material still costs $1,850,000 at the beginning. His production costs will still be $600,000 for labor, plant and equipment, and utilities, and he'll still have to pay $49,000 in interest to the bank. But now the jewelry will sell for $2,497,500. The profit before tax fell to less than nothing. The business is now operating at a loss. Because of the fluctuation of the value of gold, this is a very risky business for the jeweler. In fact, the bank is going to notice this and conclude that it doesn't want to lend to the jeweler the initial funds because there's quite a bit of risk that they won't get paid back. Of course, if the price moved the other direction, the jeweler would have quite a handsome profit for the quarter. But the jeweler can't count on that. He's in the business of using his craft to generate a dollar profit, not in the business of metals speculation. So what are the options for the jeweler? Well, one thing the jeweler can do is to negotiate a price for the fabricated jewelry ahead of time with the resellers. Of course, the smaller resellers are probably even less able to absorb the price risk for a product that will take them additional time to sell. So that's probably not going to work. The jeweler can also go into the futures market to hedge price risk, but that comes with a lot of additional cost and complexity. But what if our jeweler were able to approach a group of people who save in gold, want to be paid back in gold, can tolerate the price swings in gold, and who would love to earn a little bit of interest on their metal? Enter the gold lease. Let's now allow our jeweler to borrow 1,000 ounces of gold under the promise that 1,000 ounces of gold will be returned, plus an additional 20 ounces as interest. What does the business case look like now? Let's continue with this case where the price of gold and the finished product both fall by 10% over the 3-month production process. The raw material cost will now be booked at 1,000 ounces. This will be borrowed from the lessors and will need to be returned at the end of the lease. It will be carried on the books of the jeweler as a liability. The sales revenue is still the same $2,497,500. Production costs are still $600,000. The interest cost changes. The jeweler now only needs to borrow from the bank the $600,000 needed to pay his workers and for utilities and plant and equipment. The 2% interest on $600,000 is only $12,000, and the jeweler will need to also pay the lessors of the gold 20 ounces of gold bullion as an interest payment. So what's the jeweler's profit now? He has his dollar revenue of $2,497,500 minus his cash costs of $600,000 and $12,000 interest. But he also has a gold obligation of 1,020 ounces. The price of bullion dropped by 10%, and so his cost to replace it is $1,698,300. Well, replace it plus add the extra 20 ounces worth of gold as interest. When we subtract all of the costs from the jewelry revenue, the jeweler is left with $187,200. This is certainly lower than the original gold price neutral profit of $276,000, but it's certainly better than a loss. Before I move on, I'd like to say that this case is completely hypothetical. It was intended to demonstrate only why a gold lease could be of value to the borrower. It can significantly shield the borrower, whose business case is in dollars from adverse price swings in the price of metal. The lessor, who is willing to absorb the risk of price swings in the metal, earns interest in return for doing so, plus the risk of lending out his capital. But the key is that the interest is being paid as a result of doing something productive with the metal. It's not being paid by someone who's using the metal to speculate. Now, we've seen some spectacular and recent failures of other businesses which engaged in non-dollar loans. Now, I won't go into the details of those businesses, but I never fully understood how they used the underlying capital asset to generate value in order to pay the high levels of interest that they were promising, and so I was always highly suspicious of them. Now, there are a myriad of businesses out there that can generate value using gold as working stock. Jewelry fabrication is one of them. Another is reselling of bullion coins. One of the interesting leases that I am currently participating in is one where the gold being lent is used as the non-consumable part of a sputtering target. That is, a piece of equipment used to deposit carefully controlled amounts of gold onto other objects. Now, obviously, leasing requires a fair amount of due diligence, and the company that I trust to lease out a portion of my metal does this due diligence. That company is Monetary Metals. Let me discuss what they do now. In the interest of full disclosure, I want to tell you that Monetary Metals asked me to be an affiliate, and because I use them myself, trust them, and believe in their mission, I agreed. So, for those of you who are interested in leasing out a portion of your metal, please use the address below to get to my landing page, or use the link in the description of this video. When you talk to one of their relationship managers, please let them know that I sent you their way. In return, I'll obtain a small payment for the new business that I helped them to identify. But don't sign up just because I endorse them. Leasing out metals does involve some level of risk. It also means committing gold to a lease for a fixed amount of time, and that does reduce liquidity. So take your time and really think through whether or not this is the right thing for you personally. If it is, great. If not, that's okay too. Gold doesn't have to earn a profit to be a good thing to own. Now, with that said, let me talk a little bit more about what Monetary Metals does. Two of the benefits a Monetary Metals customer enjoys is secure storage of their metal and the opportunity to participate in gold lease deals that they identify. Oh, and they also identify silver lease deals too. Metal that's placed on deposit with them is stored in an escrow account in a vault that's managed by Fidelitrade until it's leased out. It's not listed as the property of Monetary Metals. It is the account holder's property. Monetary Metals pays for storage and insurance and arranges audits. They also provide monthly statements of account for every account holder. So one of the main benefits to the account holder is cost-free professional vault storage. So what's the hook? How can they provide a free vaulting service? The answer is that they trust that you will participate in one of the many lease opportunities that they identify. They present these opportunities to their clients several times per year. The client is presented with an information packet about each lease opportunity. If the client decides to participate, then they can offer a certain amount of metal. Once the contract is signed, the client starts earning interest on the metal that's leased. Generally, the lease rate is between 2 and 3% per year, and it will vary from opportunity to opportunity. In return for identifying, fully evaluating, and negotiating the lease agreements, Monetary Metals will also realize a percentage return from the lessee. This percentage compensates them for all of the work that they do, and it also pays for storage. So what kind of information is presented to the client in these information packets? First, there is an analysis of the gold flows through the process, including who has custody, at what step of the process, who has title, and what kind of controls are put in place to ensure the safety of the gold. Then there's a summary of the key risks. This will include a statement of the financial condition of the borrower, who the other counterparties are, etc. You know, all the bad stuff that might happen. Immediately following this is a summary of the risk mitigation plan. For example, what kind of insurance is in place? What are the personal guarantees? What kind of assurances are there that the contract specifies that the gold is not considered an asset of the borrower? And other things. There may be disclosures as well, such as if any officer of Monetary Metals has an equity stake in the borrower. Then, of course, is the audit plan, as well as negotiated interest rates and the terms of the lease. Once the lease is presented, the rest is up to the client. The client decides whether or not to participate, and this is where the client has to evaluate the risk of the opportunity for themselves. Now, I think that this is a great way to earn some income on gold, as well as manage storage at the same time. And I hope that you'll decide to check them out and see if they're right for you. And if you do, please be sure to tell them that I sent you their way. Thanks a lot for your attention. Hope you check them out and like them.